The biggest risks in finance rarely arrive wearing bright colors. They do not usually come with a slogan simple enough for television or a villain obvious enough for people to point at over dinner. Most people want to believe the next great crack in the system will come from something loud. A stock bubble everyone already talks about, a politician everyone already hates, a recession headline dramatic enough to make even lazy people pay attention. I have lived too long to trust that instinct. The really dangerous things in markets are often quieter than that. They sit in plumbing and funding chains and assumptions that became so familiar, nobody remembers they were assumptions. That is where I would tell any serious investor to look now. Because if you want to understand why mortgage rates keep refusing to behave, why the market can look calm and then suddenly twitch as if it touched a wire, why the Federal Reserve can talk about easing and yet financial conditions still feel tight, you have to go deeper than Washington. You have to go into the structure. And when you go into the structure, you begin seeing a pattern that should make any adult more serious. The problem is not one thing that is the first mistake people make. They want one enemy, one explanation, one headline they can memorize and repeat. I do not think that is how the next real accident comes. I think it comes through interaction, private credit, artificial intelligence infrastructure, geopolitical stress in places that touch energy and chip supply, and a banking system that still has more hidden exposure to fragile corners than it likes to admit. Any one of those by itself can be explained away. Together they begin to look like kindling. That is what concerns me. I am not saying this because I enjoy dark predictions. I have never gotten rich by forecasting disaster theatrically. I got rich by trying to understand where value really sat and where fragility really sat, then behaving in a way that let time work for me. This is no different. When you see enough cycles, you stop asking whether fear sounds intelligent. You start asking whether the mechanism is real. Here, the mechanism is real. And to see it properly, it helps to start with an old lesson. Back in 2008, the public believed the crisis was mainly about housing. That was only partly true. Housing was the trigger. It was not the full machine. The real damage came from the financial architecture wrapped around housing, structured products, leverage on leverage, hidden interdependence. Institutions that did not merely own mortgages, but owned instruments built on top of mortgages, and then instruments built on top of those instruments. What looked like one market had been transformed into a tower. When the first floor cracked, everything above it began discovering how much weight it had quietly borrowed from the layer below. That is always the danger. It is rarely the first asset that destroys the system. It is the architecture built around the asset. People forget that because they like simple morality tales, greedy homeowners, loose lending, bad bankers, all true in fragments. But fragments do not teach the lesson well enough. The real lesson is that complexity amplifies shocks. A fragile structure can turn a localized loss into a system event. That is what happened then. It is also why I am paying attention now, because we have built another structure the public barely understands, and public misunderstanding is one of the favorite habitats of financial risk. This time the center of gravity is private credit. That phrase sounds sterile. It should not. It now sits behind a remarkable amount of corporate borrowing, institutional yield chasing, and more recently, the giant appetite for artificial intelligence infrastructure. Years ago, when rates were pinned down and money was cheap, investors started reaching. That is what human beings always do when normal returns feel insufficient. They reach. Pension funds wanted more yield. Endowments wanted more yield. Family offices wanted more yield. Insurance money wanted more yield. The public markets did not always provide it. Banks, facing their own regulatory pressures, could not always lend where borrowers wanted capital most aggressively. So private credit stepped into the gap. At first, the story sounded sensible. Banks were becoming more selective. Alternative lenders would fill the space. Capital would flow where it was needed. Borrowers would pay more for flexibility and speed. Investors would earn more for supplying money to places banks no longer wanted to touch. There is some truth in that story. That is why the structure grew. Bad ideas rarely grow without at least one good sentence supporting them. Then came scale. Scale changes everything. Once a sector becomes large enough, the demand for deployment takes over. Money that has been raised must be put to work. That is when standards begin to drift. Not always openly, quietly. A borrower once rejected becomes maybe acceptable. A covenant once demanded becomes negotiable. A valuation once questioned becomes assumed. And because these assets do not trade like public stocks every second, they can look calm even while stress is building underneath them. That is one of the dirtiest little comforts in modern finance. If something is not marked harshly every day, people confuse silence with safety. A man looking at a slow-moving private mark feels more stable than a man looking at a public stock chart flashing red and green all day. That is understandable. It is also often wrong. Silence does not prove safety. Silence may only prove that nobody has been forced to price the pain honestly yet. Private credit lived in that kind of silence for years. Then it became tied to the largest capital spending rush of this decade, artificial intelligence. Now here again, people want an easy story. They want to say AI is a bubble, or AI is the future, or AI is overhyped, or AI changes everything. I dislike arguments that broad. I prefer looking at the bill: who is paying, who is financing, what assumptions are being made about demand, what assumptions are being made about utilization, what assumptions are being made about power, chips, cooling, networks, and lease commitments. The AI boom is not merely a software narrative. It is a physical build-out: data centers, power, networking gear, cooling systems, specialized hardware, land, fiber, cloud capacity, and a great deal of money required before the hoped for economics become visible. That matters because physical build-outs are not financed with poetry. They are financed with contracts, debt, counterparties, and assumptions. Some of those assumptions may turn out wonderfully, some may not. That uncertainty becomes more dangerous when private credit enters the room, because private credit often likes structures that keep long obligations from looking too ugly on corporate balance sheets. The public may still focus on the AI headline. The more interesting issue is how much of this expansion has been supported by financing that depends on confidence holding. That is where fragility begins. The average person hears that a major technology company is funding data centers and imagines that because the company is large, the structure must be sound. That is lazy thinking. Large companies also optimize. They look for off-balance, sheet relief, flexible lease language, cancellation rights, partner financing, and all the usual tools that make big capital commitments look less suffocating in the present. That does not make them evil. It makes them rational. It does mean that the ecosystem around the build-out may contain more hidden stress than the headlines suggest. If the growth curve softens a little, if demand disappoints a little, if utilization lags expectations a little, or if the next jump in model capability takes longer than the market wants, the finance behind the infrastructure can suddenly look less comfortable. Again, none of that requires AI to die. It only requires capital to have run faster than certainty. Markets do that all the time. Now add another layer: Iran. People are tired of geopolitics until geopolitics touches the price of what they use every day. Then they remember that maps can matter. The immediate concern around Iran is not merely military theater. It is what prolonged stress in that region does to energy. Higher energy costs raise many costs: transportation, manufacturing, input prices, confidence. The whole system gets a little more expensive. That alone is unpleasant. But there is a second-order effect many people do not see. Some parts of advanced manufacturing depend on industrial processes and materials linked indirectly to energy and refining chains. Disruptions there can ripple into the cost structure of already expensive technological build-outs. Now the AI chain gets hit from another angle, not only financing stress, but potentially rising physical cost. This is how systems start talking to each other. A person who looks at each story separately remains calm too long. A person who looks at interactions gets serious earlier. Then there is Taiwan. Again, I do not enjoy rehearsing invasion scenarios for entertainment. Most of the time, those conversations are lazy substitutes for real thinking. But if you are going to discuss the AI build-out honestly, you cannot pretend the semiconductor choke points do not exist. The global chip chain still runs through places where geopolitical confidence is not a permanent law of nature. If tensions intensify enough to affect production, insurance, shipping, lead times, or the willingness of capital to finance the next layer of capacity, the consequences do not stay local. They move straight through valuations, inventory assumptions, and corporate spending plans. That is why I keep saying this is not one story. This is what happens when private credit dependence AI capital intensity, Middle East energy risk, and Taiwan's semiconductor concentration begin leaning on each other. Each one alone can be managed. Together, they create a structure with less tolerance for disappointment. And disappointment is exactly what markets tend to deliver when the public begins believing a smooth path is normal. Now let me step back to the domestic side, because this is where people often get confused. They hear me describe all this and think I am saying a recession is guaranteed tomorrow. I am not. Timing is a vanity game in macro. I do not play it unless I absolutely must. What I care about is whether the system is becoming easier or harder to shock. It is becoming harder to absorb shocks. That is enough to change how a prudent person behaves. Look at the labor market signals. They are not catastrophic, but they are not singing weakness there matters, because spending always looks durable until employment begins to crack in a way people can feel. The public consistently makes the same mistake. It goes to the mall, sees people spending, and concludes the economy must be strong. People spend right into recessions. Sometimes they spend because they still have income. Sometimes because they still have savings. Sometimes because denial is a powerful economic force. The empty store comes later. By the time the public sees it in the shopping center, the trouble is already older than it looks. That is why I pay more attention to the labor undercurrents than to the visible consumption moment. Financial stress often begins before the consumer has emotionally accepted it. Then the stress reaches jobs, then consumption reacts. That sequence matters. The bond market gives you another clue. If the bond market were wholly convinced a clean recession was arriving immediately, you would expect a very sharp response on the short end. That is not what we see in a clean, dramatic way. Instead, you see a market still wrestling with inflation risk, term premium financing conditions, and uncertainty about whether policy easing actually translates into easy money in the places that matter. That is another reason the public gets confused. It has been trained to think that if the Federal Reserve cuts, money becomes easy. That is often untrue. The front end may move, the long end may remain stubborn, credit spreads may behave badly, financing channels may stay clogged, mortgage rates may stay higher than households want, private assets may still refuse to clear honestly. That is how a system can feel tighter than the policy headlines imply. People want one lever. Real markets use many, and now we arrive at the heart of the matter. What makes all this potentially worse than 2008 in one important respect is not that the losses must be larger in absolute terms. It is that the financial system is now attached not only to synthetic credit chains, but to real world constraints that cannot be solved by spreadsheet optimism alone. Power, water, land, chips, supply chains, energy routes. In 2008, the system cracked around housing finance and a web of engineered credit products. Today, we may have a structure where credit engineering sits on top of physical bottlenecks. That is not easier. That is harder. A mortgage security can be repriced. A missing transformer or constrained power grid cannot be wished away with a central bank speech. A semiconductor bottleneck cannot be solved by slogans. A geopolitical shipping disruption does not care that a fund model assumed gentle continuity. This is where I think many sophisticated people underestimate the risk. They are still thinking in purely financial shock language. But if the financial layer and the physical layer start reinforcing each other, the room for error narrows quickly. That is not apocalyptic talk, it is just systems thinking. Now, if you ask me what I would actually do with this understanding, the answer is not glamorous. I would not try to stage a theatrical collapse trade with my whole life. I would not turn every market dip into proof that the end has arrived. That sort of behavior destroys more wealth than it protects. What I would do is make sure I am not dependent on perfect conditions. That is always the right first move when the system becomes more fragile. Too much debt, too much leverage, too much option speculation, too much concentration in assets that require cheap capital to justify current prices, too little liquidity, too little cash flow. Those are the weak points people should fix. The investor or household who feels constant anxiety usually thinks the anxiety is caused by the news. Usually it is caused by the structure. If you are anxious, look first at your own exposure. How much leverage? How much debt? How much margin? How much income stability? How much cash buffer? How much of your net worth depends on the same macro story continuing? That is the adult way to respond, not with panic, with diagnosis. I have written this to myself more than once over the years in one form or another. If you are worried, your structure is talking to you. Listen before the market speaks louder. A person with modest leverage, real liquidity, strong income, and productive assets can survive a lot of headlines. A person with too much debt, too much risk, and too little cushion can be broken by a headline that is not even ultimately that important. Structure decides what news does to you. That is the lesson. If I owned assets I still liked fundamentally, I would not sell them merely because some journalist or analyst found a colorful way to describe risk, but I would absolutely examine where fragility has been growing. Private credit exposure through public asset managers, highly leveraged financial names, weak small and medium-sized businesses dependent on expensive floating rate financing, companies trading at heroic valuations with no margin for cost overruns or slower adoption, businesses dependent on endless cheap capital. Those are the areas where I would want to be especially honest. Honesty is underrated in markets, especially when narratives are fashionable. The AI boom created a great many real winners. I do not dispute that. It may create many more, but booms also attract loose financing, copycat spending, bad underwriting, and assumptions that the next 5 years will be kinder than history usually allows. I never trust kindness from history when capital has been rushed. I prefer to ask which businesses get paid regardless of who wins and which businesses are alive, only because money was available cheaply enough for long enough. That is a much better dividing line. If I sound calmer than the material, that is intentional. I do not want to think like a doomer. Doom is lazy. Doom requires very little ranking. I want ranking. What is real? What is loud? What is priced? What is fragile? What is still durable even in a tighter world? What assumptions no longer deserve automatic trust? That is the real work. And if I had to reduce the present situation to one sentence, it would be this. The next real danger is not one giant obvious bubble popping in isolation. It is a web of expensive assumptions around private credit, AI infrastructure, geopolitical stress, and banking exposure beginning to discover they were all leaning on each other more than anyone liked to admit. That is not a good structure. Not because it must collapse tomorrow, because it leaves the system with less shock absorption than the headlines suggest. That is enough for me to stay respectful. Respectful does not mean frozen. It means positioned. It means less arrogance. It means more liquidity. It means more quality. It means less dependence on stories that require everything to go right. I have spent most of my life trying not to need perfection. Perfection is a terrible basis for an investment thesis. The world does not provide it. Markets do not pay reliably for requiring it. And systems built on it tend to discover their weakness suddenly after years of calm. That is what worries me here. Not the existence of AI, not the existence of private credit, not even the existence of geopolitical stress. The thing that worries me is how much confidence has been built on the assumption that all of them can expand at once without eventually straining the pipes underneath. I no longer believe that assumption deserves blind trust. And when blind trust begins fading, markets become less forgiving very quickly. That is when prudence starts looking intelligent again. I much prefer getting there before the crowd does. There is another subtle reason I take this seriously. The public has been trained by the last decade to believe every stress event ends the same way. The Federal Reserve blinks, liquidity returns, the dip buyers get rewarded, the speculative names come roaring back. Everybody who stayed aggressive gets to tell a story later about courage. That pattern may not hold so cleanly if the issue is not merely monetary tightness, but financing quality meeting physical limits and geopolitical friction. At the same time, a central bank can influence rates. It cannot manufacture cheap discipline after the fact. It cannot instantly create trustworthy borrowers where weak borrowers were financed too freely. It cannot solve every power bottleneck, every supply dependency, every chip choke point, every war risk premium, every overbuilt capital plan. That does not mean policy is powerless. It means policy is not magic. Investors who have grown up thinking every problem is solved with easier money may learn that some problems become slower, messier, and more selective. That is another reason I prefer strong balance sheets, real profits, essential demand, and management teams that do not require applause to remain rational. I do not know whether the recession probability ends up at 49% or 29% or 60%. I do not know whether the trigger is labor, a private credit incident, a geopolitical shock, or simply the accumulated weight of too many expensive promises meeting a less friendly world. I do know this. When multiple weak points begin clustering, the intelligent response is not to laugh them off because each one alone sounds manageable. It is to respect the fact that modern crises travel through connections. Housing in 2008 was not just housing. It was a web private credit. Today is not just private credit. AI capital spending is not just innovation. Iran is not just oil. Taiwan is not just chips. The banking system is not just banks. They are pathways, and once the pathways start transmitting strain together, the market can reprice very quickly. That is why I still come back to the old disciplines. Do not force risk. Do not rely on borrowed money to feel intelligent. Do not own fragile businesses at perfect prices and call it investing. Do not assume every decline is a gift if you have not first asked what kind of asset is declining and why. And above all, do not let the crowd hunger for one neat explanation trick you into ignoring a system that has clearly become more interlocked and less forgiving. I have no interest in fear for its own sake, but I have great interest in staying alive, liquid enough and rational enough to buy what becomes attractive when people who mistook cheap financing for permanent reality finally discover the difference. That is how I would face this environment, not with doom, with discipline.